You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. I hope you are doing well and that you had a pretty cool weekend. On my side, I just came back from Boise, Idaho. That was a lot of fun. I was there between Wednesday till Saturday, but I'm going to tell you a lot more about it on Business Friday. For today, I want to talk about a boring business that keeps on giving and keeps on performing and shows 31 consecutive dividend increases. And just by that number, you probably have a pretty good idea because we don't have many long-term dividend growers like this in Canada. This is not a company that I have in my portfolio. It has been on my radar a few years back. In 2021. They sold a piece of their business, and then I'm like, wow, what's going on with this company? So it's Thompson Reuters, ticker TRI or TRI.TO because it trades on both Canadian and US markets. Huge company, market capitalization of 110 billion, and it was the result of the merger between Thompson in Canada and Reuters in the UK. So Thompson Reuters, like quite original, right? Back in 2008. So in 2021, they sold their financial data service called Refinitiv to the London Stock Exchange. I am actually a client of Refinitiv, so that's why it caught my attention. Today, the company is, still in the boring business. They are offering software and services to the big three. So they have like three segments. The first one is legal professionals, so to lawyers. The other one is tax accounting, so to accountants, and then corporate segments. So legal is 42% of the business, tax accounting about 20-25, corporate 20-25, and everybody knows Thomson Reuters a lot more about Reuters News, right? Which is the rest, like the print and media business. It's just a few percentage of their revenue and their profit. So not much to go into that. It's really about the major service they offer to the big three. So what I like about TRI, well, first, I love the business model. It's 80% of the revenue are coming from a subscription-based model. So obviously, subscription rhymes with recurring, and at 80%, it's pretty great. The problem, though, when you have a subscription-based model is whenever you lose clients, right? Because you get money coming in all the time, but when a client leaves, that is kind of like losing a part of your annuity. And what is great about Thomson Reuters is that they have built a pretty sticky business. So that's like one of their moat. The thing is, they operate into very high complex services. So we're talking about laws, we're talking about accounting rules, we're talking about like everything managing like big corporation. So those type of services are complex, and they also require a higher level of implication from both the supplier of the software, so Thomson Reuters, but also from the client's part. So there's a big learning curve, and once you're used to, how to use that software and you're familiar with it, well, you don't really feel like changing your subscription to start over with another service. The financial information website, the Refinitiv, was the same thing. And I can tell you that as much as I hate playing with my database, if I had to rebuild my database using Bloomberg instead of Refinitiv, for example, it would like the reason why I would do that would be, it has to be very, very major, because if not, just the time and the energy to understand a new platform, a new service connected to my business would take forever. So that's why a lot of subscriptions are never going to leave Thompson and Reuters for that reason. Since they have so many clients, they also have a lot of cross-selling opportunities. So throughout their corporate segments, they could also offer sometimes accounting or legal software, because big corporations usually have accounting and legal departments. So there's a big opportunity over there. Another opportunity for TRI is the fact that now they're operating on cloud-based software. So it lowers the cost of acquisition of clients. They can directly plug them in throughout the cloud, which helps a lot. And a place where the company is focusing right now to put more capital expenditure and making more research is obviously using artificial intelligence to boost already what they have as services. The way it works for AI, and I know you're probably very used to use ChatGPT these days, and then for the better or for the worse, it's not always giving you the right answers. But where the magic happens is when you are able to use a specific expertise. So in their case, for Thompson Reuters, they have plenty, especially throughout the legal and accounting services. So they have experts on their side, and then they can build AI to become great assistant and to analyze an incredibly large amount of data and produce reports and information, key information within seconds almost, as opposed to having a bunch of experts to actually go through that information. So those are the kind of things that they can improve, and of course offering new services to their existing clients. In terms of the dividend perspective, Thompson Reuters is a low yield, high growth stocks. So the company offers a 1.25% yield. You're going to tell me, Mike, I'm not going to be able to pay my bills, but it's pretty much the same song all the time, right? If you look at the company's total return over the past 5 years, we're talking about a total return of 200% versus the TSX 60 at 59. So I don't know, I would gladly pick up 1% yield, but do 4 times the S&P 500, the TSX, 60, right? And if you go for 10 years, it's even bigger. So over the past 10 years, the TSX 60 generated 112% in returns, which is pretty good. And then Thomson Reuters at 637%. Let that sink in for a second. 637. Of course, past performance is never guaranteed for the future, but it shows you how a stable business model that generates consistent cash flow, combined with the fact that they show you confidence in the future by increasing their dividend year after year. And they were quite generous as of late. So the last dividend increase was of 10%. So again, quite generous there, still a low yield, plenty of growth. Their latest quarter were actually showing pretty stable growth. So 9% revenue growth, 30% EPS growth. The big three was showing plus 7% for legal, plus 12 for corporate, plus 14 for tax and accounting. So everything is going well. So now you're going to tell me, but Mike, there's probably something wrong going on with that business, some risk, right? Well, of course, nothing is perfect. One thing that I don't really like right now is definitely the valuation. The stock is trading at an all-time high. You have to be ready to pay trading at a 33 times the earnings, so PE ratio of 33, forward PE is at 44, and the average of the past 5 years was 64. So trading a little bit lower than the average, but really when you look at all of this, it's kind of crazy numbers, right? So I am not sure I would be willing to pay 40 times the earnings for a company like this. On the one side, you have to pay for quality, and it's just hard to pull the trigger, and I totally get it. The other thing, and this is where I'm not still convinced I would be ready to pay such a high valuation for this type of business, is while it is quite stable, I wonder how they will be able to sustain a high single-digit revenue growth moving forward. That all depends on their ability to innovate, which so far they've been amazing, but it's still a big ask for that company to keep on asking lawyers and accounting firms and big corporations to pay more for their subscription all the time. So yes, there is a component that they have a sticky business. They could increase their prices, but I'm just wondering. So that's why holding me a little bit of like, that's definitely a concern. The other one is competition. I mean, of course, everybody wants to have a piece of this. So they're not the only player across the world doing this. And while it is quite a sticky business, if any disruptive company can enter with like better products, they could also lose a part of the market share. The thing here is, since the company is valued as it would grow big time all the time, that becomes a bigger risk because the market expects Thompson and Reuters to fly high and keeps on generating crazy returns. So I hope that you have enjoyed this 10 minutes podcast on Thompson Reuters. If you want to see more companies like this, you can download the Dividend Stocks Rockstar list at moosemarkets.com/rockstars. So the Rockstar list is literally a list of companies showing a strong dividend triangle, similar to the one that we can find for Thompson and Reuters. So a strong dividend triangle means revenue, earnings, and dividend growth over the past 5 years minimum. So again, moosemarkets.com/rockstars. I compile those. I update them every single month. So you get that throughout your newsletter as long as you subscribe to the newsletter, of course. All right, guys, that's enough for today. Sorry for like the long 11-minute podcast on this one. I hope that you have enjoyed, and we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.